Welcome back to Talk Tickers. We're your shortcut to understanding corporate finance, breaking down earnings calls so you don't have to.
And today we're doing a deep dive on the Paychex Q2 fiscal 26 call from December 19th.
This one was a really interesting puzzle.
It's a classic financial riddle, yeah. On the surface, you see a company that delivered, they beat on profitability, they posted this huge double-digit revenue growth.
But the stock sold off hard.
Because investors looked right past that nice adjusted earnings number and they zeroed in on two things. A massive, and I mean massive, surge in costs and, some real signs of softness with their clients.
And that's exactly what we're here to dissect. We have to unpack the story Paychex is telling, which is, hey, these are just temporary costs, versus what the market is clearly worried about, which is slowing organic growth.
We'll dig into the real price of that big Paycor integration, look at their new guidance, and see how AI fits into their whole competitive strategy.
Okay, so let's just lay out the numbers that caused all this confusion right up front.
Absolutely. Let's start with the good news.
The good news. Paychex reported adjusted diluted EPS of $1.26. That sailed past the street's consensus of $1.23.
And that's solid. That's up 11% year over year. That really signals that, the core operation is healthy.
It does, but then you look at the revenue line, and the story gets a little less perfect.
A little less, yeah. Total revenue hit about $1.56 billion. Still fantastic growth. I mean, that's up 18% from last year, mostly because of the acquisition.
But it just missed. It was a narrow miss, but they were expected to hit $1.57 billion.
In that little miss, that was really all investors needed to start getting nervous, especially when you pair it with the cost problem.
Right. And you could see that problem clear as day in the GAAP numbers. That's the unadjusted figure, the real bottom line.
Yeah, that's the one without any of the asterisks.
And the GAAP diluted EPS was only $1.10. That is actually down 4% from $1.14 last year.
And that's the headline that spooks people. A drop in profitability. It doesn't matter what management says about adjustments. That's what sets the tone.
So the market sees that drop and immediately starts digging into the expense structure.
Of course. And that's where things get really interesting.
So let's talk about the expense story. The reason for that GAAP miss, the reason for all the nervousness, was the total expense line. It just surged.
A whopping 27% year over year. It hit $985.7 million. I mean, we're talking nearly $1 billion in expenses in one quarter.
And this wasn't just, them spending more on marketing or something. It was almost all because of the Paycor integration.
Exactly. Management was very clear. They said about $77 million of that was directly tied to the acquisition. And it hit their SG&A, their selling, general, and administrative costs the hardest.
So SG&A is where they're putting all the messy costs of just smashing these two huge companies together.
Yep. Retraining sales teams, getting rid of old software, merging offices. That $77 million is the upfront price they're paying for those future synergies.
Which is why you have to look at the two different margin numbers to really get what's happening.
You do. If you just look at the raw GAAP operating margin, it's painful. It compressed sharply, fell all the way from almost 41% last year down to 36.7%.
And that's what the market is reacting to today, that drop.
But here's the other side of the coin. If you strip out that $77 million in, let's call it integration noise, the adjusted operating margin actually went up.
It expanded by 80 basis points to 41.7%.
And that's management's whole argument. They're basically asking investors, please ignore the temporary mess, look at the core business. It's actually getting more efficient. It's a bet on their ability to execute.
So strategically, the core business is running better than ever, but the accounting just looks ugly for a little while.
That's the pitch.
Okay, so let's talk about where that 18% revenue growth actually came from.
Well, the segment breakdown really shows why they bought Paycor in the first place. Management Solutions, which is their core payroll and HR tech business, grew 21% to over $1.1 billion.
And Paycor was most of that.
Almost all of it. Management said the acquisition contributed about 17 percentage points of that growth. So the deal is doing what it was supposed to do, which is buy top-line growth.
What about the other parts of the business?
They were pretty resilient. The PEO and Insurance Solutions segment, that grew 6% to about $337 million. Management was bragging about their market-leading employee growth there and near-record retention.
And you can't ignore the interest income. the float.
Oh, absolutely not. That's a huge tailwind right now. Interest on funds held for clients, it shot up 51% year over year to 54 million.
51%. Wow.
That's a huge benefit of higher rates, obviously, but they also said they were strategic about repositioning Paycor's portfolio to get a better yield. So that's becoming a really significant profit center for them.
Okay, so we've got the numbers. Let's dig into the qualitative side. We know the integration cost $77 million this quarter, but what about the upside? Are they getting the synergies they promised?
The answer there is a pretty confident yes. In fact, they said they're exceeding their original cost synergy targets.
Oh, really?
Yeah. They were originally aiming for $80 million in savings for fiscal 26, and they've now raised that number to $100 million.
Okay, that's a 25% bump. That definitely gives investors some confidence that the money they're spending today will pay off.
It's a positive signal. But the market was also really focused on Paycor's own growth rate. What was the organic momentum of this thing they just bought?
Right.
Management estimated that the underlying pro forma growth for the Paycor business was somewhere in the 8 to 9% range for the quarter. Now, they did say that number was tricky to calculate because of some accounting changes.
Wait, hold on. 8 to 9%. If you're spending $77 million a quarter to integrate a business, shouldn't it be growing faster than 9% to justify that kind of drag?
And that is the billion-dollar question, isn't it? The growth is good, but it's maybe not explosive enough to make people forget about the huge integration cost and the margin hit.
It feeds right into that cautious feeling.
Yeah.
Which, I guess, brings us to the demand trends they're seeing.
This is where the story pivots from their own internal costs to what's happening out in the real world.
And what did the CFO say during the Q&A? This was the real core of the problem, right?
It really was. He was very direct. He said their small business clients are becoming very cost conscious. They're putting every single new purchase under a microscope, looking for immediate ROI.
So how does that actually show up in the sales numbers? Are people just not buying?
Not exactly walking away, but they are definitely changing how they buy. Management said they're seeing smaller deal sizes across the board.
And less product attachment.
Way less. Instead of buying the big bundle with everything, clients are picking the lower end bundle. So maybe they'll buy 2 modules instead of the full suite of 3 or 4.
That's a huge tell. It means the small business owner isn't saying no, they're saying not yet. They'll pay for the stuff they have to have, like payroll, but they're pushing off the nice to haves.
Exactly. They said there are a lot of shoppers out there, so the interest is high, but those shoppers are being really careful with their wallets. It feels like they're waiting for the economy to feel a bit more certain.
What's so weird is that while clients are tightening their belts, Paychex's own data says the labor market is actually pretty stable.
That's the disconnect. Their Small Business Employment Watch Index is stable, same-store employment growth was flat. They literally said they see no signs of a recession at this time.
So Paychex doesn't see a recession, but their clients are acting like one is just around the corner.
It seems like it's more about inflation and just general cost management than it is about them planning for big layoffs.
Got it. And before we get to guidance, can we just touch on the PEO segment again? You said the core PEO business is strong, but there was a drag there.
Right. The drag is entirely from the insurance agency part of that business. It's still a headwind because of softness in workers' comp rates and lower volumes for health and benefits.
Okay, so if you put all this together, the integration costs, the cautious clients, the strong interest income, it makes sense that the forward guidance was a bit of a mixed message.
A true mixed bag. On the one hand, the good news, they tightened and raised their full-year adjusted EPS growth outlook to between 10 and 11%.
Which is a huge vote of confidence. It says they believe in those cost synergies and their ability to control expenses.
It does. But then the caution flag came out for revenue. They were really clear that they expect total revenue, management solutions revenue, and PEO revenue to all land toward the low end of their guided ranges.
And that's a direct result of those smaller deal sizes and cautious buyers we just talked about.
It is. They're basically admitting that organic growth is going to be a tougher climb than they first thought. The one bright spot was that float income. They now expect that to be at the high end of the $190 to $200 million range.
So let's shift to strategy. In the call, they talked a lot about AI as a competitive moat against rivals like ADP, Workday, and Oracle.
They really hammered this point home. They basically have a 2-part defense. First is their customer base. The CEO pointed out that over 70% of their clients' employees are in blue or gray collar jobs.
Jobs that are harder to replace with AI.
Much harder. You can't replace a construction worker or a factory technician with a large language model. Not yet, anyway.
So their revenue is more insulated from that kind of disruption.
That's the argument. And their second defense is their revenue model itself. They have a big fixed fee component, which protects them if employment numbers fluctuate a little. A competitor that's purely per employee per month gets hit harder by even small job losses.
Okay, so that's the defense. What about offense? What are they actually building with AI?
They were really excited about their new patent-pending AI-powered knowledge mesh system.
Yeah, that sounds complex.
It's basically a system that takes all their unstructured data, every phone call, every email, every support chat, and turns it into this searchable, connected brain. It helps their own teams and powers their Gen AI compliance platform to keep up with thousands of changing laws.
So they're using AI to make their own people smarter and faster.
Exactly, and more efficient. They talked about successful pilots where agentic AI handled thousands of basic payroll calls and emails with almost 100% accuracy.
That's a huge operational win.
It's their path to scaling the business. They think they can grow without having to add a proportional number of new employees, which lets their human experts focus on high-value advisory work that keeps clients happy and loyal.
And it absolutely backs up their confidence in that raised EPS guidance.
It does.
All right, this brings us to our segment. This is not financial advice. This is where we put on our high-risk hats and pitch a hypothetical, outrageous but plausible trade idea. Remember, we are not financial advisors.
And the setup here is pretty interesting. You've got a stock that's getting hammered, down over 21% in the last year, while the S&P is up almost 15%. And you have management actively buying back more stock, signaling they think it's undervalued.
So what's the pitch?
We're calling it a cleanup alpha paired trade. The idea is to go long Paychex ticker PAYX and short a basket of their peers who you think are more exposed to white-collar AI disruption or who don't have that strong advisory and fixed fee model.
And the thesis is all about the accounting mess clearing up.
It's entirely about margin convergence. You have phenomenal free cash flow, $1.2 billion in operating cash in just 6 months. You have a clear timeline, maybe 12 to 18 months, for that $77 million in quarterly expense drag to fade away.
And as that noise goes away, the company's really attractive underlying adjusted margin of almost 42% starts to show up in the GAAP numbers again.
Exactly. The accounting fog lifts, the market starts focusing on the raised EPS guidance, and the valuation should, in theory, push back toward its historical premium.
It's a bet that management can clean up the mess while keeping the core engine running efficiently.
A bet on execution.
So to wrap this all up, what does it mean for you? The core tension here is so clear. You have strong growth and a real path to $100 million in synergies on one side.
And on the other, you have this huge near-term drag from integration costs and a small business client base that is clearly getting nervous about the economy.
So the key things to watch are the execution checkpoints.
Absolutely. First, you need to see that $77 million expense number start to actually shrink over the next few quarters. And second, you need to see some momentum come back in the upsells and cross-sells to fight that smaller deal size trend.
And before we go, here's a provocative thought for you to chew on. Management is really confident that their focus on blue and gray collar clients makes them safer from AI disruption than their rivals.
The question is, should investors now be specifically screening all HR and payroll companies on their AI employment risk profile? Or is management's confidence maybe understating just how big the disruption could be for the entire industry?
Something to think about. Thanks for trusting Talk Tickers with your deep dive.
We'll see you on the next one.